This John Lothian news video is sponsored by London Metal Exchange had quite a year in 2014, from its integration into the Hong Kong exchanges and clearing, launching its own clearinghouse, and addressing the metals warehousing problems. LME now has the pieces in place for expansion. Garry Jones, CEO of LME, spoke with John Lothian News about the exchange's focus on China and the potential for new products in the coming months.
The LME is a medium-sized exchange with a very large parent. That parent is very focused on Asia and particularly China. And so our business, given that 40% of the world's metal production and consumption is in China, we're focused on that as well. So our two lines and our two themes, if you like, one is geographical. We're continuing to try and increase Asian participation in our markets. We have one of the highest percentages of Asian time zone trading already. We have around 20% of our electronic trading before 8 a.m. London, which is a very high percentage. On days when there's lots of activity there, our volumes just rocket. Every week we get new Chinese people trading on the market. We get Chinese entities setting up as members. So the geographical is important for Asia, particularly China, but also with Korea, Japan, Australia, Indonesia, India, etc. So that's where we see the growth. Not so much in Europe, a little bit in the US, South America, Eastern Europe, but really Asia. So geographically very important. And then on products, if you've built your own clearinghouse, you've upgraded your technology, you want to push more through the market. You want to give members access to more markets trading on your exchange. And we'll start by going to the adjacent markets in commodities. We're not going to start trading index futures and stocks. That's not our market. But we will start looking at precious metals. What more than start, we're already the world's reference price for platinum and palladium. We're looking at clearing precious metals and trading them in due course. And with steel and iron ore and things like that, it's a natural adjunct to us as well. And then premium contracts, which show the premium between the LME price and the all-in price. There's a North American premium, Northern Europe, Japan and Asia. We're launching those later this year as well. Well, the LME is still undergoing great change from last year. Under the parentage of Hong Kong Exchange, we continue to add more resources. We've launched our clearinghouse in September last year, one of the first new clearinghouses in Europe for some time. Latest technology, latest risk methodology, delivered to market in a very short time against the backdrop of significant regulation. We've insourced all our technology now, so we have a very big technology department, and that's another 84 people. In fact, we've tripled our numbers at the LME in the last 2 or 3 years. We're moving to a new building later this year. We're looking to get into new markets. We're looking at precious metals. We're looking at ferrous markets. We're looking at premium contracts. A whole load of stuff going on. So lots of positives. We've been in the courts a few times this year. I'm pleased to say we're 3-0 at the moment in winning our litigation. But everything around the delivery process and the physical side of the metal market is still very important. Clearly, we still have queues in a couple of warehouses in the aluminium market. We're still working on that. We put a big consultation out, in fact, 2 weeks ago. We also announced changes to the structure of what we're doing, both in terms of the warehouse agreement and the physical setup of that. So we're still pushing with that. We're working with regulators as well to ensure that those queues come down as soon as possible and that we move forward with a more efficient market. Obviously, it's not a problem in isolation, okay? I mean, these queues grew after the financial crisis of 08-09, quantitative easing, low interest rates. When it became apparent you could store material in a warehouse funded at 0.5%, lock it a 2-year forward, positive carry for a risk-free rate higher than US Treasuries. Of course, people are going to do it. Of course, metal producers are going to not close mines and smelters if they can help it. So anything they can do to keep material off the market, they will do. And, the LME's been around 130-odd years. These problems are fairly new, and we have to deal with them. So we're not saying there isn't a problem. We're saying that it's under our rules that these things have happened, but it's not really our fault. We're doing everything we can. But we do have to operate within the law. We have to operate within our regulatory licenses that we have. And I think that, our goal is to make sure we have a liquid, efficient market that meets regulatory requirements. We can't just change the rules because we feel like it. That's why we have to consult so much, and that's why we have to focus on it. I think in the US there's a bigger focus because consumer groups in the US are quite a big lobbying force with their senators and then into the regulatory process. So you hear more about the noise here, perhaps, than you do elsewhere. But of all the warehouses now, queues have come down to zero, except in 2 places, Detroit and Vlissingen, Detroit in the States, Vlissingen in Holland. And we hope, in the near future, there'll be none at all. We have the sort of double whammy. We've got all the European legislation, including MiFID, EMIR, MiFIR, and other things going forward. And then in the US, you have Dodd-Frank and the follow-on to that. We also have foreign border trade application in the States as well. So we care about what happens in the States. We have an ongoing dialogue with the CFTC, an ongoing dialogue with the FCA in London, and then all the European College of Regulators in all the other countries as well. And then if we want to deal in Asia, we have to talk to the SFC in Hong Kong, CSRC in China, etc., etc. So we spend a lot of time on that. And I'm afraid some of the European regulation at times just adds costs, and does it make it a better market? I'm not so sure. There's certain types of regulation around EMIR in Europe which may end up pushing more out of clearing, when clearly the regulatory push is to get things in clearing. If you make it too expensive to clear, then people start to trade more OTC, which is clearly not the way the regulators want to go. And just simply launching a new market. I mean, this is an important thing. If we want to launch a new market on the LME, we have to get through our internal process. We have to obviously do the technology. We have to get the FCA as the exchange's regulator to approve it. Then we have to get our clearinghouse to approve it as well, their risk committee. Then the Bank of England, which supervises the clearinghouse, and then the European College of Regulators and ESMA that the Bank of England work with. So from a standing start today, if you and I dreamed up a product now, it's 9 months to a year to get going on something. Now you may say, well, is it going to be safer? Is it going to be better? Possibly, but it seems to me to be a little too long. It's a very big year for us because we brought in a new fee structure at the start of the year. Obviously, the clearinghouse came in, and we've got different risk methodology for there. So I think it's really delivering, in a full sense of the word, what we've already started.